All right, so we start with chapter 14. Kind of the way the class will be structured is I will do a narrated PowerPoint lecture, put it out there the first of the respective week. In this case, week 1. I'm doing this for chapter 14. Next week will be, I believe, I want to say chapter 15. No, I think that's chapter 17. So anyway, excuse me, 16. So this week 14, next week 16. So we'll start out with the narrated PowerPoint tomorrow, and after I do the narrated PowerPoint, obviously I'll put it out there on Canvas in the respective week. So under week 1 you'll see this narrated PowerPoint for chapter 14. Then tomorrow what I'll do is I'll actually go in class. It'll be just like you're sitting there in class, and what I'll be doing is a problem in set B at the back of the chapter 14, and then I'll ask you for an assignment to turn in for a grade to do the exact, well, not exact same, but a problem from set A that corresponds with the problem I did in set B that's pretty close. So you'll have something to go by when you're doing your assignment, okay? And then do the assignment, do the quiz, and you're done. All right, so again, this is managerial accounting. Why are we starting out managerial accounting talking about financial statement analysis? I guess I would have two comments to that. First of all, in financial accounting, you could certainly fit this in financial accounting because obviously the financial statements are prepared in conformity with financial accounting standards. So the problem is you just can't fit all the chapters into one term. So you got to put it somewhere. So here we are in managerial accounting. The other justification for having it in managerial accounting is because managerial accounting is any type of accounting that helps management and other employees make good decisions. And the financial statement analysis that is done may be on the company that the analyst is working for. Certainly they want to project the best financial statements they can. A lot of times, though, what you're doing is you're making decisions, you're analyzing the financial statements of other companies in order to make a decision. One of the things that is really big in the commercial trades is credit, selling on credit. 99% of all trade transactions between companies is done on some sort of trade credit with some sort of credit terms. Well, companies aren't just going to sell to anybody sight unseen, not knowing what the company that they're proposing to sell to, how they're financially situated. So part of what happens is before you open up a line of credit for a company you're going to have somebody within the selling company reviewing financial statements of the buyer company to determine if they are creditworthy. Bankers, loan officers, this is what they do. They're not just going to loan money to anybody. You go in, you're a company that goes into your financial institution for a loan. First question they're going to have is, okay, let's see your financial statements, current financial statements. So these financial statements are there to help managers and other employees within a company make better decisions. You want to sell to companies, other companies who only are creditworthy, are deemed creditworthy. So that's probably the biggest reason that it's in Chapter 14, other than the fact we don't have time to fit it into financial accounting because there's just too much stuff to go over. All right, so let's start. So financial statements are formed in such a way that help with analysis. Remember who the users are of these financial statements. They're usually people outside the company. And again, think of a situation where you're reviewing a company to see if you want to sell them, but there are other situations. You are a potential investor. You're not just going to invest in any company. You want to review the financial statements of the company you're thinking about investing in. So there's that. And there's several other scenarios that we could talk about, but the main thing is anytime you are looking at a company, you want to have a user-friendly financial statement. So most of these financial statements are user-friendly. They're designed for analysis. Now, how do they do so? Well, first thing, if you recall, most companies have what are called classified financial statements. So they bunch groups of numbers, groups of accounts by classification, by characteristics. And so, for instance, in your balance sheet, you're going to have current assets bunched together and then long-term assets bunched together. On the other side, you're going to have current liabilities bunched together, and then you're going to have long-term liabilities bunched together. And then you're going to have your various components of shareholders' equity as well. You're going to have, in many cases, what are called comparative financial statements. You're going to have side-by-side years so that you can compare current year's financials with last year's and possibly even more than beyond last year's financials, so that you can compare the numbers side by side. And so what that does, it helps identify significant changes and trends. Normally, you're going to have to go to some sort of analysis beyond the dollar amounts. You're going to have to get into percentages and things like that, but many times companies provide that information as well. When you have a company that actually has a parent company and at least one subsidiary, but possibly more subsidiaries, you're going to have consolidated financial statements. And what that does is it takes all the financial performance of all the companies and puts the numbers together so that it looks like one company, one consolidated company, because it really is one company. All right, so some of the tools of analysis that we'll be talking about are dollar and percentage changes. The other thing we'll talk about is trend percentages. We'll talk about component percentages, and really the big one is, in my mind at least, having done this for several years, is ratios. All right, so dollar and percentage changes. Dollar changes is simply taking the number, the amount from what they call an analysis period and comparing it with a base period. Okay. Now, dollar changes to me not as important as percentage changes, because you could have companies in the same industry that have wildly different sizes. For instance, if you looked at Target versus Walmart, certainly you would say that Walmart and Target are competitors, okay? But if you look at the raw numbers, you will note that Walmart's, from a strictly dollar standpoint, Walmart's dollars are much bigger than Target, okay? And so it would be very difficult to compare from a dollar standpoint Target to Walmart. Now, certainly if you're just looking at Walmart strictly from one period to the next, dollar change may mean something, it may not. So it's not totally useless, but to me, it's not as relevant as looking at the percentage changes. All right, so percentage change is simply the dollar change divided by the base period amount. So some standards to think about in this dollar and percentage changes when you're evaluating them. Sales and earnings should increase more than the rate of inflation. So always keep in mind that there is some sort of rate of inflation. Also, in measuring quarterly changes, compare the same quarter in the previous year. So if you're comparing the first quarter of this year, what you would want to compare that with is the first quarter of last year or year before or something like that, because the main thing there is you want to make sure that well, for companies, a lot of companies, they are cyclical, and so their sales might, in my example, might be bigger in the first quarter than they are in other quarters. And so it wouldn't be relevant to compare the first quarter of this year with the third quarter of last year if the third quarter is not their big sales time of the year. And note that the percentages may be misleading when the base amount is small. If you're starting out with a small base, changes that increase that could be misleading. So the example they have is you start out with $10,000 net income in year one, because you're just starting the business. And then in year 2, you have a $100,000 net income. Well, comparing the base of net income of $10,000 to $100,000, you've got a 900% increase. Well, why do you have that? Well, it's because your base, the $10,000, is such a small number. All right, so here what we're looking at is a company with comparative income statements from year 13, 14, and 15. And so here's the raw numbers up at top. Down below, you have the change in percentages. So you've got your net sales there, you've got your net income, and then over to the right bottom area, you've got your increase or decrease. So 2014 when compared to 2013, they have in raw numbers a $100 increase. That's probably, $100,000 increase from 14 over 13. That's a 25% increase. Net income, though, actually went down $10,000, which is a 20% decrease. So that's how you read those. Your base is 2000 in that 2013 in that case. And then, of course, they have it comparing 2014 to 15, with 2014 being your new base in that example. And so computing these changes in sales, gross profit, and net income provide an insight into the company's rate of growth, or as you saw in the example before, it might be the rate of non-growth in the case of net income. So in measuring the dollar or percentage change in quarterly sales or earnings, it's customary to compare the results of the current quarter with those of the same quarter in the preceding year. So we already talked about that. And what this does is it prevents seasonal distortions. And again, when percentages are in the base, when the base is small, percentages can be misleading. And so here you have an example in year 1, income $100,000, year 2 income's $10,000. Well, you've got a 900% decrease in income, and then next year you go back to the same amount of income as in year 1. That's a 900% increase over year 2. Obviously, it's no increase over year 1. So you'd have to do some digging to find out what happened in year 2, because from a percentage standpoint and certainly a number standpoint, that's a pretty wild swing there. Something must have gone on, and so they're suggesting maybe there was an extraordinary transaction like a tornado loss. All right, trend analysis is used to reveal patterns in data covering successive periods. And so here what you're going to do to figure out the trend percentage is you're going to take as your numerator the analysis period amount. Let's say, well, that's usually going to be the current year, and you're going to have as your denominator your base period amount. That could be the previous year or could be 5 years past or something like that. Some year in the past usually. and you're going to multiply that percentage times 100%. And so here, in this example, we've got sales and net income for this company for years 2010 through 2015. Your base year is 2010. Everything else, all the other years, are analyzed based upon the base year of 2010. So the $300,000 sales and net income of $15,000 in 2010 are all 100% from a trend percentage standpoint. And then you compare the successive years, 2011 through 15, based upon that base of 2010. And so, for example, in 2015, let's look at 2015. Sales of $450,000 when compared to 2010, your base year, is 150% of 2010, right? 450,000 is 150% of 300,000. From a net income standpoint, 2015, the 22,950 is 153% of the 2010 net income of 15,000. So that's how you read those. All right, so component percentages. They indicate the relative size of each item included in a total. So again, here you're going to use the analysis amount as your numerator, your base amount as your denominator, and you're going to multiply that number times 100%. And so for the financials, well, depending on the type of financial statement, you have different types of base amounts. For a balance sheet, usually your base amount is going to be total assets. For your income statement, the base amounts usually going to be revenues. So here, what we have is income statement, and your base is going to be in this net sales, your revenues. So that's your 100%. And then you're going to compare all the other components of the income statement with that base. And so looking at 2015, cost of goods sold is 70% of net sales. Expenses are 25% of net sales, and net income is 5% of net sales. So that's how you read that. One thing you want to be concerned with in analyzing these financials is the quality of the earnings. And so, especially for investors, they're interested in companies that demonstrate the ability to earn quality income and at a growing rate each year. You don't want too much up and down stuff because that creates instability for the analyst. And so note that while satisfactory earnings may be a good indicator of the company's abilities to pay its debts and dividends, you have to also consider the composition of assets, their condition and liquidity, the timing of repayment of liabilities, and the total amount of debt outstanding. All right, here is something you should be familiar with, a classified balance sheet. And again, you've got current assets lumped together and then totaled. You've got your plant and equipment, your long-term assets lumped together, and then other assets. All right, ratios. Ratios are used probably more than anything else. It's not the only thing, but it's probably the most important analysis tool that analysts use. And so a ratio is a simple mathematical expression of a relationship between one item and another, along with dollar and percentage changes, trend changes, and component changes. Ratios can be used to compare past performance to present performance, and so that's, you're analyzing within one company, the numbers within one company there. You can also compare competitors, or even a company compared to industry trends, or industry standards. So there's many different uses for these ratios. All right, and so the first type of ratio we want to talk about is liquidity ratios. And so liquidity refers to the company's ability to meet its continuing obligations as they come due. If you are a short-term creditor, you are a trade creditor, you sell supplies to a company, this is primarily what you're interested in, are liquidity ratios of the company you're analyzing. All right, so the first thing we want to look at is strictly a raw number. I wouldn't put too much stock in this because it's, again, a raw number, and probably the only thing that really matters is that you want this number to be a positive number and not a negative number. And so that is working capital, which is the excess of current assets over current liabilities. So you simply take your current assets and subtract current liabilities for your raw working capital number. You want that to be a positive number, but I mean, it really, until you get that down to a percentage, you really can't compare that even within the company, different years, or between companies, competitors. And so more importantly than the amount of working capital, the strictly dollar amount, is using those numbers, your current assets and current liability numbers, and figuring out what the current ratio is, because that you can take that number and compare it with previous years of the same company or between different companies, competitors. So current ratio is current assets is your numerator, current liabilities is your denominator. What is a good current ratio? Well, certainly anything above 2 to 1. In other words, you have twice as many current assets as current liabilities. In most industries, it's going to be a pretty decent number. The higher, the better. Remember, in some of these ratios, a higher number is better. In some ratios, lower number is better. So you have to kind of know that. Current ratio, the higher the better, to a certain extent. Now, the thing about current ratio is it's got some stuff in it that, some of the components of current assets are not very liquid, okay? Remember what you have in current assets. You've got cash, marketable securities, all highly liquid. You've got accounts receivable, not as liquid, but still pretty good expectation of turning that into cash. So those three things usually pretty liquid. But then you have inventory. Inventory is a current asset. Well, you can have a lot of inventory. That does not mean you can pay your bills if you've got a lot of inventory, because a lot of inventory means you've paid money out for the inventory, but you've yet to turn that into a sale. And until inventory is turned into a sale, thus a receivable, you have no expectation of turning that into cash. So for that reason, because of inventory and also prepaid liabilities, what analysts try to do is look at not only the current ratio, but even more importantly, a good indicator of liquidity is this quick ratio. So you have your quick assets, which are cash, marketable securities, and receivables as your numerator, and your denominator is current liabilities. And so what's a good number? Well, the closer you can get to a 1-to-1 ratio, quick assets and current liabilities, the better. If you're a little bit less than 1-to-1, that's still probably pretty decent. If you're getting down into the 50% range with your quick assets versus your current liabilities, you could have some liquidity problems. You could have some problems paying your current bills. And so in this case, quick ratio is 106 over 100,000, so it's 1.06 to 1. The next one they talk about is the debt ratio. And so here, your numerator is going to be total liabilities, and you're going to divide that into total assets. And so in this case, you've got total liabilities that are 1/3 of total assets. This number, unlike the first two ratios we looked at, those first two ratios, you want to have a higher number, okay? Here, it's just the opposite. You want to have a low debt ratio. You want fewer liabilities to total assets. The lower the number, the better. All right, so uses and limitations of financial ratios. As far as uses, ratios help users understand relationships in the financials. Ratios provide for quick comparison of companies within the same industry, competitors. Limitations. Managers can enter into transactions merely to improve the ratios. Ratios do not help with analysis of the company's progress towards non-financial goals, okay? So these numbers, I think the main thing in there that you need to know is that sometimes these numbers can be manipulated. The next type of ratios we want to look at are profitability ratios. And so here you're going to be looking at the income statement primarily, And note that income statements can be multiple step, usually are multiple step in the larger companies. Sometimes they can be a single step format, but many times the multiple step format is the one that's used. And so here we have an example of a multiple step income statement. So you've got here, always starts out with net sales. This is a manufacturing company. So you've got, or maybe it's could be a manufacturing company or a retailer or merchandiser, as they're called. So here they've got inventory, so it shows cost of goods sold, and so you've got gross profit that comes out of that. Net sales minus cost of goods sold equals gross profit. And then after that, you've got your operating expenses, which includes selling and general administrative expenses. And so you've got your operating income that comes from that. Then you've got some non-operating items and unusual items that you have to deal with to come up with net income. So the main thing out of there is net sales minus cost of goods sold equals gross profit. And then you take gross profit, and from that you subtract selling and administrative expenses to come up with total operating income. And then if you have other non-operating items, you deduct those to come up with net income. And so here, profitability ratios are going to be one of them is net income as a percentage of sales, or net sales. And so here, net income is your numerator, net sales is your denominator. So net sales is your base. In this instance, $72,000 is 8% of the $900,000 net sales for this company. Another ratio used to determine profitability is earnings per share. So here you're going to take as your numerator net income, and you're going to divide that into the average shares of capital stock outstanding. And that average shares is going to be your beginning number of shares, a beginning year number of shares of capital stock outstanding. You take that and you add it to end of year capital stock outstanding. And so you add those two numbers together and then you divide by 2. That's your average shares of capital stock outstanding. And so in this case, you've got your net income of $72,000. If you look back at the numbers from the previous example, you've got the average number of shares of capital stock outstanding is 15,000. So your earnings per share is $4.80 per share. Okay. This number, you want that number to be larger. Investors want to see a large earnings per share number. Another profitability ratio is price earnings ratio. And so here your numerator is going to be current market price of 1 share of stock. Now this only works with publicly held companies. If it's a private company, they're not going to know the current market price for 1 share of stock. And you're going to divide that into EPS, the ratio in the previous example. And so here the higher the price earnings ratio, the better. And so it shows the relationship between earnings of the company and the market price of the stock. You would think that, well, you would want a higher price earnings ratio. That's bottom line. Note, in the single step, you've got a much simplified grouping, but it comes up with the same bottom line numbers. Another asset, or excuse me, another ratio that we might want to look at is return on investment. Now, in the book, you've got return on investment and return on assets, and took me about 5 minutes to figure out what is going on here. But basically, these are the same ratios. Return on investment and return on assets are exactly the same. They have return on investment as annual return over average amount invested. And if you notice, return on assets is operating income over average total assets. Well, those, I mean, it's just two ways of saying the same thing. So ROI and ROA are exactly the same ratios. And so the ratio is a good measure of the efficiency of utilization of assets by the business. The more profit when compared to assets, the better. So you want a higher number here. And so in this case, you've got operating income of $120,000. You've got average total assets, which is you figure out your total assets at the beginning of the year, figure out your assets at the end of the year. You add those numbers together and divide by 2. That's your average total assets. And so here, again, the percentage you want to be higher rather than lower. Return on equity, very similar. It's taking your net income and dividing it into your average total equity. This would be your beginning of the year equity plus end of year equity and divided by 2. And again, you want a higher number rather than a lower number. Not really concerned about dividend yield, but here you want a higher number as well. Now, if you're looking at long-term analysis, you're going to be loaning money or some asset and being paid back over an extended period of time. That's what this is about. And so the first ratio is the interest coverage ratio, also called times interest earned. And so times interest earned is your operating income before interest and income taxes, and dividing that into your annual interest expense. And so the bottom line is you want this number to be higher rather than lower. The more times that your operating income can pay interest expense, the better. Provides more assurances to long-term creditors. And again, Debt ratio, we looked at this before, simply total liabilities divided into total assets. You want this number to be lower. And again, we looked at some of these already, but coming back to short-term creditors, you would want to look at accounts receivable turnover rate. Simply, this is your net sales divided into average accounts receivable, which is beginning year accounts receivable plus end of year accounts receivable divided by 2. And again, you want a higher number here. You want to turn over your accounts receivables more times in the year. What does the 15.25 times mean? It means that they collected their receivables 15 1/4 times during the year. So you could divide that into 360, which is generally a better number to use than 365. And essentially what they're doing is they're collecting their receivables every, what would that be? 360 divided into 15. Basically, they're collecting their receivables about every 24, 25 days. You know, if you've got 30-day terms, that may be pretty good. If you got 60-day terms, that's darn good. Inventory turnover rate. This measures the number of times merchandise is sold, and then you know, you have inventory that turns into receivables and then eventually turns into cash. This tells you how many times during the year that inventory is sold and replaced during the year. And so cost of goods sold is your numerator, average inventory, which is beginning of the year inventory plus end of year inventory divided by 2. And in this case, you've got the number 7.83 as your percentage. Again, you want this number to be higher. You want to turn over your inventory more rather than less. Remember what the operating cycle is. I've kind of alluded to it, but that's what it's called. It's when you're taking cash, turning it into merchandise, whether that is purchasing the raw materials and converting it to a finished product, or just buying the merchandise from, you know, a manufacturer and turn around and sell it. You have cash that you turn into inventory. You want that inventory to be turned into a receivable. You want that receivable to be turned back into cash. So the more times per year you can do that, the better. You want your operating cycle to be speedy, not slow. And that's it. Tomorrow we'll do a problem in problem set B.